Good afternoon, students. This is Professor Harpreet Kaur from Khalsa College for Women, Sidmakud. Today, I am going to discuss the topic of profit prior to incorporation from corporate accounting. Now, we will discuss its meaning first. Profit prior to incorporation is basically the profit earned or loss suffered during the period before the incorporation of the company, and it is a capital profit in nature, and it is not legally available for distribution as a dividend to the shareholders of the company, because a company cannot earn profit before it comes into existence. Profit earned after incorporation, that profit is known as revenue profit, and that profit is available for the distribution as a dividend to the company's shareholders. For this, we can take an example that if a business is purchased on 1st January 2021 and certificate of incorporation is granted to the company on 1st May 2021, and the final accounts are being prepared on 31st December 2021. Now we can calculate the months from the date of the purchase of the business up to the incorporation period, that is of 1st January 2021 to 1st May 2021. Now we can calculate the months from these time period, that is 1st Jan to 1st May, that is 4 months, right? Then we can calculate the post incorporation period, that is 1st May from 31st December 2021. Now these 4 months are the profit prior to incorporation, and 6 months are the post incorporation period. Now we will discuss about the how to ascertain of profit or loss prior to incorporation. Now we will discuss about the steps first. Now first of all, we have to prepare the trading account for the whole period, that is from the date of purchase of the business up to the last date where the books of accounts are to be closed, right? Then we can calculate three ratios here. Three ratios are very important for this purpose. Like, first ratio is time ratio. How we can calculate this? How can we calculate this? Like, we have done this example, like 1st January to 1st May, like 4 months and 6 months. Now we can calculate the ratio of this, right? Time ratio is basically calculated from the date of purchase of business to the date of incorporation, and from the date of incorporation to the last date of the closing of the accounts, right? Then sales ratio. Then the next ratio is of sales ratio. Sales ratio, or like for example, we have given the data that sales of pre-incorporation period is rupees 1 lakh, and the sales of post-incorporation is rupees 3 lakh. Now we can calculate the ratio 1 lakh is to 3 lakh, right? The ratio will be 1 is to 3. Then all the expenses related to sales will be divided in this ratio, that is of sales ratio 1 is to 3. Now the next item is like gross profit. Now gross profit should be a portion between two periods, that is the basis of pre and post incorporation, right? And some expenses that are directly related to the sales, like for example, cost of sales, discount, commission on sales, discount allowed, bad debts, advertising, selling expenses. These all expenses are related to the sales, so we will apportion the all the expenses into the sale ratio, right? Then we come to the fixed expenses. These are fixed in nature, and for example, like salaries, rent, audit fees, insurance, journal expenses, stationery, printing expenses, and depreciation of the assets. These are to be apportioned on the basis of the time ratio, right? Now we some expenses are incurred after incorporation period of the company, such as director fees, preliminary expenses, interest on debentures, goodwill written off, and these expenses should be apportioned wholly, and it is to be transferred to the post incorporation period, right? Similarly, some expenses like salaries of partners is debited to the pre incorporation period, as we discussed earlier. Now we can take an example. We can take a practical problem of this. We will discuss about how to calculate the post incorporation period and pre incorporation period. Now we can take a practical example. We have a question that Sneha Limited was incorporated on 1st July 2021, to acquire a running business. Sneha Limited has acquired the running business from Atul Sons, right, with effect from 1st April 2021. And during the year 2021-22, the total sales are given to you, that is of 24 lakh rupees, out of which 4 lakh 80,000 are considered to be the 6 months sales. Right, now we can calculate from the sales that what is the post incorporated sales, and what sales belongs to the post incorporation period. And the gross profit is given to you 3,90,800 rupees. Some expenses are debited to the statement of PL and account, like director's fees. Director fees is given to you 30,000 rupees. Bad debts 7,200. Advertising 24,000, but under a contract accounting, these 2,000 per month is given to you. Salaries and journal expenses 1,28,000. Preliminary expenses written off is 10,000 rupees, and donation given to a political party by the company is 10,000 rupees. Now the question is asked that prepare a statement showing pre-incorporation and post-incorporation period for the year ended 31st March. Now first of all, we will calculate the total sales, and we will calculate the sales ratio and the time ratio. First we will calculate the sales ratio. Now we will take from the question that total sales of the year. Total sale is given in the question, that is total sale during the year is 24 lakh rupees, right? Here it is given 24 lakh rupees. We will write here 24 lakh, right? Then the next step is we have given the first 6 months sale, that is 4,80,000, right? Sales of 6 months, that is 4,80,000 rupees, right? But we have to calculate the time period, like the business has been purchased by Sneha, that is on 1st April 2021, right? And the incorporation period is of 1st July 2021. Now we can calculate the months from 1st April to 1st July, that is April, May, June. There are 3 months, right? It means post pre-incorporation period is 3 months, and the remaining is from incorporation period of 1st July 2021 up to the closing of the books of account, that is of closing books of the accounts, and the remaining months are 9 months, right? Now we can calculate the sales for the period of 3 months. Now how can we calculate this? Total sale is given to you 24 lakh rupees, right? And out of this 4,80,000 belongs to 6 months. This is a 6 months, and we have to calculate from 3. Now we can calculate this. The amount is 2,40,000 rupees. Now the sales of 3 months is 2,40,000 rupees, but we have total sales of 24 lakh rupees, and we have to calculate the remaining 9 months. So we can subtract total sales minus sales of first 3 months, right? The answer will be 21,60,000 rupees, right? Now we can calculate the time ratio. Now the period is like the business has been purchased by the Sneha Limited on 1st April 2021, and incorporation period is of 1st July 2021, and the books have books have been closed on 31st March 2022, right? Now we can calculate the months from April to July, that is April, May, June. There are 3 months, and the remaining is of 9 months, right? So the ratio will be 1:3. Time ratio is 1:3. Now we can calculate we have the performer of this. Like we will write here Sneha Limited. Sneha Limited. We get a statement of, this is a statement of profit prior to incorporation. Right? For the year ended 31st March 2022. Now we will write here particulars. First format will be revenue from operations, that is sales. Now first month sale we have calculated 4,80,000 rupees. First month sale is 2,40,000 rupees. And 9 month sale is 21,60,000 rupees. This is a sales of first 3 months. This is a sales of 9 months. This sale belongs to the pre-incorporation period, and this sale belongs to the post-incorporation period. Now second is other incomes. Other incomes are not given to you in the question, so this is nil. Right? Now we can calculate on the third total income. That is 2,40,000 rupees and 21,60,000 rupees. Now come to the expenses. Expenses are given here. Now we will calculate the COGS, that is cost of goods sold. Cost of goods sold, like sale of the whole period, that is of 24 lakh rupees. We will subtract from here the gross profit. Gross profit is given in the question, given in the statement, 3,90,800 rupees. Answer is 20,09,200. Right? Now because this is a cost of goods sold, so we will calculate it in the ratio, we will apportion this in the ratio of sales ratio, that is 1:9. The amount will be 2,09,920, and here 18,08,980. Now next point is employees benefits expenses. First, salary is given to you 1,28,000. Salary is to be apportioned in the time ratio 1:3. Pre-incorporation is 32,000 and post-incorporation 96,000 rupees. Now other expenses, advertising, as we discussed earlier, advertising to be apportioned in the time ratio, that is 1:3. Amount will be 6,000 and 18,000 rupees. Next are bad debts. Bad debts to be apportioned in the sales ratio 1:9. Bad debts are given in the question, that is 7,200. 7,200 rupees. The amount of the pre-incorporation is 7 20, and the post is 6,480. Now, next amount is donation to a political party. Donation given to a political party. Donation is 10,000 rupees. Now, as we earlier discussed that some expenses are related to the post incorporation period. So this will be transferred to the post incorporation period. The whole amount will be transferred to the post incorporation period. That is then 10,000 rupees. Now the next is preliminary expenses. These are also related to the post incorporation period, as we have discussed earlier. Preliminary expenses are 10,000 rupees. Right. Now the last one is director fees. Director fees also belong to the post incorporation period. Amount is 30,000. Now we will calculate all the expenses. Grand total will be done. We will add all the expenses from here: employee benefit expenses, salaries, other expenses, advertising, bad debts, right? Now we will calculate the profit. Total income minus all the expenses. That is 360. We will 2,40,000 minus 23,000, 2,39,640, and last post incorporation period's profit is 1,81,240 rupees. I hope the topic is clear to you. Thank you.